If you are collecting Social Security right now, or if you plan to within the next 10 years, I want you to stay with me for the next 3 minutes, because there is a number inside your Social Security account that most retirees have never looked at that determines exactly how much your check could be increased, and that the Social Security Administration will never call you to explain. I'm going to show you what that number is, where to find it, and the 5 moves that can change it permanently in your favor. There is a gap between the Social Security benefit most retirees collect and the Social Security benefit they were legally entitled to collect. For some retirees, that gap is small. For others, it is several $100s per month. Multiplied across a 20 or 25-year retirement, the difference between the check most people accept and the check they could have had is not a rounding error. It is a number that changes what retirement looks like. The gap exists not because the system is unfair and not because the rules are designed to confuse you. It exists because the 5 moves that close it are never explained to you clearly before the moment they matter. The Social Security Administration processes your application. It does not counsel you on whether you chose the best moment to file, whether your earnings record is correct, whether you have access to a benefit on a spouse's or former spouse's record that would pay you more than your own benefit, or whether a decision you made years ago can still be revisited. That is what this video is for. My name is Marcus Steele. I'm an enrolled agent licensed by the federal government to represent taxpayers directly in front of the Internal Revenue Service. I work with retirees on Social Security strategy, tax planning, and retirement income protection every week. And the most consistent thing I have found in 20 years of this work is that the retirees who collect the most from Social Security are not the ones who were luckiest. They are the ones who knew the 5 moves I'm about to describe and acted on them at the right time. Every one of these moves is legal. Every one of them is documented in the Social Security Administration's own rules, and every one of them is available to a retiree at some point in their claiming journey. Some require action before you file. Some can be taken years after you have already been collecting. I will tell you clearly which is which for each one. The first move is the one that produces the largest dollar impact, and the one that the most people talk about without ever being shown the real numbers. Delay your claim past your full retirement age. Your full retirement age is 67 if you were born in 1960 or later. For every month you delay claiming Social Security past that age, your benefit increases by approximately 2/3 of 1%. That works out to 8% per year. From full retirement age to age 70, that is 3 additional years of 8% annual growth. A retiree with a full retirement age benefit of $2,000 per month who delays to 70 collects $2,640 per month instead. The difference is $640 every single month for the rest of their life. In 2026, the maximum Social Security benefit for someone who delayed to age 70 is $5,251 per month. The average benefit for someone who claimed at 62 is significantly lower. The gap between those two numbers represents decades of claiming decisions compounded across millions of retirees. Now I want to be precise about something that most explanations of this strategy skip, because the precision matters. Delayed claiming is not the right decision for every retiree. For a retiree in poor health, for a retiree who has no other income source and cannot afford to delay, for a retiree whose spouse has a much larger benefit and whose own benefit will not be the survivor benefit, the break-even calculation may not favor delay. The break-even point, the age at which total lifetime benefits from delaying exceed total lifetime benefits from claiming earlier, is typically in the mid to late 70s, depending on the specific benefit amounts involved. The decision to delay is a bet on longevity. The longer you live past the break-even point, the more the delay pays. The shorter your life expectancy, the less favorable the delay becomes. What I can tell you with certainty is that most people who claim early do so without running the break-even calculation at all. They claim at 62 or 63 because the money is available and because waiting feels risky. They make a permanent decision without modeling what it costs over a 20-year retirement. Run the calculation before you file, not instead of claiming early if that is the right choice for your situation, but with the full picture in front of you, so the decision is informed rather than reflexive. That is move number 1. The second move is the one that produces the second largest impact, and that a significant number of retirees are eligible for right now without realizing it. Check your earnings record for errors and correct them before you file. Your Social Security benefit is calculated from your 35 highest earning years. The Social Security Administration takes the wages your employers reported on your behalf over your career, adjusts them for inflation using a wage index, averages the top 35 years, and applies a formula to produce your primary insurance amount. That is the number your benefit is based on. That calculation depends entirely on the accuracy of the earnings data in your record, and the earnings record has errors more often than most people assume, Employers make reporting mistakes, names change, and records get fragmented. Early jobs, particularly from before 1990, sometimes have incomplete or missing earnings data. If a year of earnings does not appear in your record, or appears at a lower amount than you actually earned, your benefit is calculated as if those earnings never happened. If you have fewer than 35 years of earnings on record, the Social Security Administration fills the missing years with zeros, which drags down your average and lowers your benefit. The correction process is straightforward, but it requires documentation. Pay stubs, W-2 forms, tax returns, or employer records from the years in question. The older the error, the harder the documentation is to locate, which is why checking the record years before you file is dramatically more valuable than checking it the week you are ready to claim. Log into your Social Security account at ssa.gov. Navigate to your earnings history. Review every single year, from your first job to your most recent employment. Confirm the earnings amounts are accurate. If something is missing or lower than it should be, gather whatever documentation you have and contact the Social Security Administration to initiate a correction. A single corrected year of earnings can increase your monthly benefit by $30 to $60, depending on the amount involved. Across 2 or 3 corrected years, the improvement can be meaningful enough to change your monthly budget in retirement for the rest of your life. That is move number 2. The third move is the one that applies to the largest number of retirees who are already collecting and who have never been told they may have a second option available to them. Check whether a spousal or divorced spouse benefit would pay you more than your own benefit. If you are married, you may be entitled to a spousal benefit equal to up to 50% of your spouse's full retirement age benefit. The Social Security Administration pays whichever is higher, your own benefit or the spousal benefit. It does not pay both. But if your own benefit is less than 50% of your spouse's full retirement age benefit, the spousal benefit fills the gap automatically when you file, as long as your spouse has already filed for their own benefit. If you are divorced after a marriage of 10 years or longer and you are currently unmarried, you may be entitled to a divorced spouse benefit based on your former spouse's record. The same 50% rule applies. The same higher of calculation applies. And crucially, your former spouse does not need to know you are filing, does not need to consent, and is not affected in any way by your claim on their record. The average retiree collects around $2,000 per month in benefits, but applying for spousal or divorced spouse benefits could boost payments by hundreds of dollars per month for those who qualify. The mistake that costs people this benefit is assuming they already know whether they qualify. Many retirees assume that because they had a full career of their own, the spousal benefit does not apply to them. That assumption is only correct if their own benefit exceeds 50% of their spouse's full retirement age benefit. If it does not, they are leaving money on the table every month. Call the Social Security Administration and ask specifically what benefit you would be entitled to under your spouse's or former spouse's record. If you have been collecting on your own record for years and have never had this comparison run, ask them to run it now. The comparison takes minutes. The result can change your monthly payment permanently. That is move number 3. The fourth move is the one most retirees have genuinely never heard of, and the one I specifically want you to pay attention to if you have already filed and are wondering whether that decision is permanent. It is called the suspension strategy, and for a specific category of retiree, it can significantly increase the monthly benefit going forward, even after benefits have already begun. If you are between your full retirement age and age 70, and you are currently collecting Social Security, you have the legal right to request a voluntary suspension of your benefits. When you suspend, the monthly payments stop, but the delayed retirement credits continue to accumulate. Your benefit grows by approximately 0.2%. For every month the suspension is in effect, the same 8% per year that applies to delaying before you file. When you resume benefits, the monthly amount is permanently higher based on the months of suspension credit that accrued. A retiree who suspends for 2 years between 67 and 69 increases their monthly benefit by approximately 16% permanently. There are important limitations. You cannot suspend benefits if you are receiving benefits based on someone else's record, such as a spousal benefit. And if your spouse is receiving a benefit based on your record, suspending your benefit also suspends theirs. The suspension strategy works best for a single retiree or for the higher earning spouse in a couple where both are collecting on their own records. But for the retiree who claimed at full retirement age or slightly before, who is now in their late 60s, who is in good health and has other income to cover living expenses during the suspension period, this strategy can put hundreds of additional dollars per month into their check for the rest of their retirement. It is not available after age 70. The window closes at 70. If this applies to your situation, the time to act is now. That is move number 4. The fifth move is the most straightforward of all 5, and the one that every retiree and near retiree can do today, regardless of where they are in the claiming process. Review your Social Security withholding and make sure you are not overpaying tax on your benefit. When you filed for Social Security, or at some point after you started collecting, you may have filled out a form called the W-4V that instructs the Social Security Administration to withhold a flat percentage of your monthly benefit for federal income tax. The options are 7, 10, 12, or 22%. Many retirees chose 10 or 12% to be safe and have never revisited that decision. The problem is that the withholding is a flat percentage of your gross benefit. It has no relationship to your actual tax liability. It does not account for the new $6,000 senior bonus deduction that went into effect for the 2025 tax year. It does not account for whether your total income falls below the Social Security taxation thresholds that determine how much of your benefit is taxable in the first place. It just takes the percentage you chose and removes it from every check month after month, whether you owe that amount or not. For many lower income retirees, particularly after the senior bonus deduction is applied, the correct amount of federal income tax they owe on their Social Security benefit is zero. And they are still having 10 or 12% withheld from every check because nobody told them to update the form. That overpayment comes back as a refund in April. But in the meantime, the government has been holding your money for 12 months at 0% interest while you operated on a monthly budget that was smaller than it needed to be. The fix takes 15 minutes. Calculate your actual tax liability on your Social Security based on your full income picture, including any new deductions you qualify for. If you owe nothing, file a new W-4V with the Social Security Administration to stop the withholding. If you owe a smaller amount, adjust to the 7% option and verify it matches your real liability. The form is available at ssa.gov. Every month, your withholding is higher than your actual liability. Is a month you're effectively giving the government a no-interest loan. That loan ends the moment you file the updated form. That is move number 5. Let me close with the thing that connects all 5 of these moves into a single idea. Your Social Security benefit is not a number that was handed to you and cannot be changed. It is a calculation based on decisions you made and records that were kept on your behalf. The decisions can still be optimized in some cases, even after you have filed. The records can be corrected if they are wrong. The withholding can be adjusted. The spousal or divorced spouse comparison can be run. The suspension window is open until 70. The maximum Social Security benefit in 2026 is $5,181 per month. The average check for retired workers is $2,076 per month. The gap between those two numbers is not entirely explainable by earnings history. A meaningful portion of it is explainable by the 5 moves I just described, taken by the people who knew about them and not taken by the people who did not. You now know about them. Before I close, I want to give you something to take with you. I put together a free checklist, my 2026 Social Security Maximization Checklist. It covers the delayed claiming break-even calculator for your specific benefit amount, the earnings record review and correction process step by step, the spousal and divorced spouse benefit comparison worksheet, the voluntary suspension eligibility checklist and the window timeline, and the W-4V withholding review guide with the Social Security taxation threshold calculations. Every item includes the specific action and the form or resource to use. To get it, go to marcusgravestacks.com/checklist. The link is in the description. If you know someone who is within 10 years of claiming and has never had these 5 moves explained to them clearly, send them this video today. The moves that increase a benefit permanently have windows. Some of those windows close at 70, some close the day you file, none of them reopen. That is what this channel is here to do. I will see you in the next one.